You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
Welcome back to Options Bootcamp. This is indeed the program for you, the basic retail options traders looking to learn more about options and how to incorporate them into your investing portfolio. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. If you haven't checked out the latest addition to that network, listeners, I encourage you run, don't walk, over to either our mobile app or the mothership, theoptionsinsider.com, and check out the latest edition, Options Oddities, where we break down a lot of cool, unusual activity, and we do something a little bit different with that show. We record it live every day in the swim lessons room over there on the TD Ameritrade platform. So if you're a TD client, maybe you're thinking about becoming one, surf on over there and check it out for yourself. We'd love to have you there. You can interact with us live on the show, watch our charts and our graphs and all of our fun, lively banter there on the old program. Of course, you can find all that stuff in iTunes, Stitcher, AHA Mobile, as well as, of course, theoptionsinsider.com. No shortage of places for you guys to find your favorite Options Insider Radio Network programs, including this one, Options Bootcamp. And I am joined, as always, on the old Bootcamp Drill Instructor Squad by my nemesis in life, none other than Mr. Dan Passarelli, the founder of Market Taker Mentoring. Hello, my nemesis. Welcome back to the program, sir.
Oh, it's always good to be back. And, quick story for everybody. And I sent Mark a text or email or something about this last week. We were out, the Market Taker team, well, at least I was, out in Kansas City visiting one of our fans, one of the Bootcamp listeners who went out of her way and actually gave me my very own black hat. It is true. So thank you, Kat.
That is pretty cool. Are you wearing it right now?
I may be. You don't know that either way.
That's the fun of an audio program, sir, as we can always pretend. We're always wearing fancy hats here on the old show. Well, you have your hat. Do you have your whistle? Are you ready to go, sir?
I'm ready to go. Let's do this thing.
All right, then let's dive right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, and welcome to the basic training segment. This is indeed the portion of the program where we break down some basic option strategy, some options concepts that you may want to be familiar with and you could utilize in your own trading and in your own portfolios. We covered a wide array of topics on this program, all of them pretty much for the most part centered around the equity and index option landscape. That's where the lion's share of you guys are coming from. Of course, most of you coming from the stock world, looking to add some income, some protection to your portfolios, and hence you found us here on the old Options Bootcamp. And we, of course, welcome all of you as well. But there are some other use cases for options and indeed some other products you may want to explore as you're expanding your portfolio. And inevitably, after people come to the world of options after a certain point, they start inquiring and start peeking over into the realm of the futures and indeed the futures options. And those products offer exposure to a wide array of interesting products. A lot of people like to use gold to hedge a portfolio against inflation. Well, the futures and the futures options are a great way to do that. Of course, exposure to the ags or the energy sector or whatever segment floats your boat, the futures can provide a lot of exposure to that. But that segment can also be a little bit intimidating to the newcomers when they check out the landscape of futures and indeed futures options for the very first time. So we're going to dive into some of that today, outline some of the basic similarities and differences between trading regular old equity and index options versus futures options. And you should be surprised how much is the same, but there are a few nuanced differences we want to point out here, so we'll do that. And before we dive into that, Mr. Passarelli, my nemesis in life, I'll start with you. When people come over there to MTM and they ask you for the first time, hey, I'm thinking about checking out these here futures options, what do you typically tell them?
I mean, basically, I tell them that no problem. If you've been trading equity options or if you've been trading ETF options or index options, it's not really a big stretch. I mean, trading options is trading options. Just analyzing the underlying is just basically one part of trading options, but all the same concepts, the same Greeks all apply. Theta, Vega, Delta. I mean, there's a whole lot of overlap, and it's not much different.
So you're right, Dan. It isn't really a big problem, but there are some nuanced differences that are worth pointing out on a program like this. First off, like Dan said, pretty much a lot of the things we've discussed on this program in the past are applicable if you're looking at futures options as well. So if you're talking about using some of the strategies we've outlined in the past, a protective put to hedge an underlying component, a covered call, collars, vertical spreads, iron condors and spreads with wings, et cetera, all of those concepts still apply and still work essentially the same with a few minor differences in the realm of futures options. The first thing you're going to have to realize is if you're going to trade futures options, clearly the word futures is in there. You're going to need to have an account that can handle futures. So that's the first step you'll need to take care of with your broker is applying for a futures account. Usually that's a pretty simple process. Most brokers have streamlined that at this point to essentially you go onto the website, you click a couple of forms, you click yes, I agree, and it's done in a few minutes and you're approved. It's a pretty streamlined process. So that's nice. It used to be a much more laborious process. Now that said, you don't ever really have to trade futures. You don't ever have to touch the underlying if you don't want. You can just stay with the options. But they need to make sure that if you do get assigned or you need to get a future in your account, you can do it. So that's the need for that. So that's the first step we always point out to people who are thinking about using these products is unfortunately you still have to go through the hurdle of setting up a futures account. Again, much more streamlined process than it used to be. A lot of brokers have even made it a single interface so they combine both the equities and the futures accounts. You can see it all at one. So it's a lot easier from a end user perspective than it used to be, but still there is that one minor step. And then once you have that set up, then like I said, the strategies work essentially the same. Vertical, spreads with wings, all that kind of fun stuff. They all work essentially the same. But there's one more important caveat I would like to mention here when you're trading options on the futures is that we've talked in the past on this program about volatility and volatility skew. And that, of course, is the level of implied volatility in the option by strike and as it varies by strike. If you chart it out, how that looks. And typically when we talk about skew here on this program, we're referring to what's known as investment skew. That is indeed the put options, the options below the at-the-money strike, have a higher level of implied volatility versus the call options, which are the strikes above the at-the-money strike. And that's to all the factors we've discussed many times on this program in the past. People do a lot of hedging activity, so they're constantly buying puts, hence they're bidding up those levels of implied volatility, and they're selling calls to either finance those puts or just to generate income. So as a result, they're depressing the level of implied volatility on those strikes. So it tends to look like that typical investment skew graph where the slope gets steep to the put wing and narrower, shallower to the call wing and flat up in that range. Where In the commodity realm, it's a little bit different. Most products don't trade on an investment skew. They can trade on any number of different skews. A lot of commodities have fear to the upside. Increasing price of that commodity is where the concern is, and therefore all the hedging activity is to the upside. So you might see a spike in implied volatility to the upside as a result. So the call wing catches a bid as opposed to the put wing. You might see some products have what's known as the volatility smile rather than the volatility skew. So that means no matter which direction you go from the at-the-money strike, whether it's north into the calls or south into the puts, they're both going to essentially increase in volatility. No matter where that product goes, it's going to increase in vol as a result. So there's a variety of different skews you could see exhibited in a commodity product. And I would encourage you to pay attention to those when you start trading these products, because once you start trading options on them, that's going to impact how they perform. Writing a covered call, for example, in a product with a steep upside skew is going to be a much different beast than it is than in a simple equity where the underlying actually, as it increases, the implied volatility drops off. It's going to perform a lot better. It's going to be a much richer return, but of course, there may be other consequences to that as a result, particularly if you're doing a lot of spreads that span the options chain, doing a lot of risk reversals or long verticals and things like that, iron condors that involve multiple strikes. That's when you might see those skew differentials playing into the pattern. So if you're used to a world where you're writing downside puts and getting a lot of premium for them and buying upside calls because they're very cheap, coming into commodities, it may be a different beast entirely. Dan, you have any comments on skew and how it might impact people trading futures options for the first time?
Yeah, this is something that I saw, I want to say maybe 2002 or so, maybe even 2001, probably 2002. It was sort of after the internet bubble burst. During the internet bubble is when I started trading, sort of in the middle of that. I started trading as a market maker and in equity options. And damn it, that was a great time to be an equity options market maker.
Yes, it was, sir. The good old days.
I made a lot of money for a few years. And then, the market kind of slowed down. Just like any other business, it's all cyclical. And so I was looking for other opportunities, just like any other businessman, right? And so what I did is I went across the street from the Chicago Board Options Exchange to the Chicago Board of Trade, where the grains were heating up. And so I went and I stood in the corn options pit. And, I was aware of things like variations in skew where it may not be the same as the equity options, and, kind of sat there and watched the market for a day or two and figured out that there was a very, very distinctly different skew to those options. Back then, the put side, there was a kinked curve to the downside because back then the government had a floor on grain prices. So at some point, the market couldn't fall below there. So the put skew just sort of fell to zero because there was no volatility below a certain point. But of course, with things like commodities, with food, grains, the fears to the upside, that can be very inflationary. So the call side was very, very expensive relative to the put side. And, like I said, these are some of the nuances that are subtle, but they're important. I mean, you have to know them if you're going to be trading in a different asset class rather than equities like we typically talk about.
I didn't know you were a diehard corn guy.
Oh, I've done it. I have done it before, indeed.
Did you ever go into the lean hogs as well, sir? How far afield did you get?
No, just dabbled in the corn options. I stood in the soybean futures for a little bit, but that's a whole different animal, baby.
But you're right, Dan. There are a lot of interesting things at work in these products, and certain things that have to be people have to be cognizant of when they're trading them. Another thing that may influence you when you're trading futures options, a lot of people come to equity options for one of their primary benefits, that is leverage. Of course, you come in and buy an underlying stock. The best you can do on margin is 50%. You come in and buy the option, you get leverage to a much higher degree, and that is what a lot of people are looking for when they're buying premium, when they're buying options. The benefit of doing that in the futures realm is diminished because at the end of the day, the underlying can be had for a much cheaper rate than the stock. You can buy futures, of course, on a very, very small initial margin payment. And of course, that will fluctuate. You have to deposit and credit as the underlying fluctuates. But essentially, the leverage benefits of using futures options aren't really as clear and as tantalizing to a lot of people as they are on the equity side of the fence. At the end of the day, you can just buy the future if you want a lot of margin and leverage there. It's a leveraged instrument in and of itself. Some of the values, of course, of doing that, though, of trading the futures and indeed the options on the futures, is that the products are usually much larger in notional size. So if you want to get a lot of size off in, let's say, gold or corn, the futures are going to be a good way to do that. In fact, they could be too big for a lot of people maybe listening to a show like this, and places like the CME have realized that, and they've started to come out with a lot of mini products in recent years to make it much more palatable to a typical retail trader who just doesn't want to trade 10,000 bushels of corn. They just want a little bit of exposure to that market when they have some sort of viewpoint there. And so they realize that's a growing audience for them, and so they're making a lot more mini products to do that. So if you are looking at the futures realm, I encourage you to search and see if there is a mini or some sort of more bite-sized type contract you can look at, because then if they have the mini futures and options on those, that could be much, much better sized for your portfolio than the large contracts that we're talking about. Now, that's to say there are benefits to using futures options, and they come into a lot of the products that we just mentioned, like the corn, like Dan's old corn adventures, and indeed the lean hogs, but also a lot of other products like the oil and energy futures and the metals and the FX and currencies and all that fun stuff. But there are some products that also you could use a vibrant ETF as an alternative as well. Two of the best examples of that are, of course, in the metals realm, GLD and SLV. A lot of you guys are probably familiar with them already. The reason I hold those out as shining examples is because, A, they track the underlying very well, unlike a lot of other ETFs that purport to do that but don't really do a good job of doing that, like, let's say, a USO. But also because they don't have the same problems of roll yield that a lot of ETFs do. Of course, futures operate on a term structure. Typically, the farther off futures cost more than the near-term futures. A lot of these ETFs that don't hold the physical, they have to hold the futures, and they end up rebalancing on a regular basis, buying expensive longer-term vol, selling cheap near-term vol. Doesn't take a genius to realize it's going to hurt you in the long run. Could be 10, 15%. Sometimes these products lose to roll yield every month as a result. Something like a GLD or SLV holds the physical. It's relatively immune to that. So that's a nice benefit of a product like that. So if you are looking at some alternatives in the commodity realm, you may be a little leery about futures. Some of these ETF options, I stress some. Some of them could be exactly what you need. GLD, also a more bite-sized, retail-friendly product, and SLV, then the big gold futures and options. Of course, they do have minis out there now as well to make those more palatable. There's fewer options, pun intended, when you get farther out into some of the products like energy, for example. A lot of people are looking at crude oil right now, WTI, Brent, all the other things that are going on out there. There's not as many ETF options out there for you. There are products like USO, but they don't really track the underlying very well. So in those scenarios, if you're looking to express any sort of outlook on oil or have any sort of opinion, you want to diversify into oil and want to use the options, WTI and the Brent and some of the other ones are really the only options you have, pun intended again. So that's unfortunately the problem with a lot of that product area is you're essentially limited to the futures. Ags, same thing. There are a lot of mini products you can choose from now. But if you want to express a viewpoint in corn's been pretty much beaten to death lately. So if you think it's going to keep going down or going to rally, there's a lot of ways you can do that using the big corn options, of course. Wheat and soybeans, all the same. Another area where the ETFs tend to really fall short, products like corn and bale don't really do a good job of tracking the underlying. The one area where there is a vibrant ETP space and also a vibrant futures market is indeed the volatility space. We've touched on this a little bit on the show in the past. It's also what I like to refer for a lot of people as kind of the gateway drug for a lot of people getting into futures options. They hear about VIX on something like a CNBC, people talking about the VIX cash and the VIX is up, the VIX is down, the fear gauge, et cetera, et cetera. They started investigating it. They want to trade options on it, and they discover, hey, this is actually a futures options product. There's futures here. So that might be their first introduction to real futures and futures options type product is by trying to trade the VIX. So they have to set up a futures account. They start to learn things like term structure. And so the VIX is a good starting point for a lot of people in terms of cutting your teeth on a futures option and learning how these products work, how term structure impacts a product, how the options key off different months' futures and things like that. All things that you need to be aware of. Again, when you're talking futures options, I can't stress this enough. Stock and an index, they don't typically expire. They're there forever. You buy IBM, it's in your account till you sell it. Futures, of course, have an expiration date, just like an option does. So when you're buying options, make sure you're looking at the right future that price keys off of and when they expire, because they have to have matching or similar expiration dates so you can see exactly if you're trading an option on, let's say, an October option, and you're looking at the future that expires in June, you're probably keying off the wrong product. You should be looking farther out the expiration chain. So that's where people get screwed up a little bit on futures options as well, as they have an expiration date for the options, they have an expiration date for the underlying, and it starts to get a little bit much for some people. And also, we've seen a lot of people trying to look at the futures options and, let's say, a volatility product, and then deciding, this isn't for me. I'm going to go into a VXX or a TVIX or a VXY, all these other products. And they, of course, get disadvantaged with a lot of the problems I've listed here before about things like roll yield impacting those products very negatively. And so it pays to do your homework when you're looking at these types of products. The futures options realm, a lot of that same stuff applies, but there are a few nuances, like we said. Let me wrap it up here, too, with, of course, you don't need to go crazy far afield into commodities. That's one way a lot of people like to use futures. But, of course, you can also look at financial futures. You can look at the big S&P futures, and the options on those. You can go the big ES options, or you can go the SPX options. There's a lot of financial-oriented products as well. So if you're leery about commodities, you don't want to pull a Dan and head out to the corn pits. There are financial futures products as well. Dan, what is your barometer? When do you make that switch? When do you decide I'm going to use a futures option here versus, let's say, an ETF option like a SPY or something else?
There's kind of a pretty involved, multifaceted answer to that. I mean, as far as just simply, hey, I could trade the equity market by using, an ETF or an index or a future or the options on any of those three. For me, I'm mostly in the securities options game, so, I would probably be using an ETF. I would probably be using the securities options that are cleared through the OCC. But that being said, you have to kind of think in terms of product categorization and like asset diversification. If you're trading stocks, that is the equities market. But then, there's the basket that would be considered commodities. And then there's the basket of an asset class that would be considered volatility. So you're kind of broadening your horizons and giving yourself exposure to different asset classes when you trade in these baskets. Now, what's interesting, especially working with students mainly in the securities options world, most of our listeners, I think, have heard of the Market Taker class that we have each morning, the Market Taker Live Advantage Group Coaching class, where in that class, our students get about 15 brand new equity option trade ideas every single day. And that's not hard to do when there's, I don't even know how many there are these days, probably 4,000 optionable stocks. It's hard to keep track. I bet it's even more now. I bet it's probably 5,000 optionable stocks out there. So yeah, for us to come up with 15 different trade ideas a day, that's nothing. But about maybe, a year or two ago, I looked to start that same sort of class with futures options. But one of the problems we ran into, we ran into a couple of problems with that. We don't have the class anymore. One of the problems we ran into is with future options, there's maybe 15 liquid things to trade out there. I can't come up with 15 new trade ideas unless I'm coming up with a new, oil idea today, a new gold idea today, a new, corn idea today. There's just not that many different things you can trade with futures options yet. To Mark's point, they keep innovating new products, but still, for what's liquid and what's available, there's not a whole lot. So that was one of the things. And then another thing is, truth be told, as far as people who are trading options out there, by and large, most of them, almost all of them, are trading exclusively equity options, securities options. Just like finding students. I have a lot of people every week who are emailing me about different classes and such I have. Almost all of them are looking for education in securities options. And that's why that's pretty much mostly what we provide now.
Good points, as always. Mr. Passarelli, and you're right, the futures options realm isn't the most full of choice, shall we say. There are a handful of products that really trade a lot, euro dollars and the front month corn and stuff like that. And once you get beyond some of those products into the lean hogs and the lumber, like I was joking earlier, it does get a little thin, and the dairy and some of the other more esoteric type products. So it's certainly something to keep an eye on as you're starting to dip your toes in these waters, listeners. Just to wrap up, this is kind of brief overview of futures options versus equity options. First off, futures are primarily useful if you want to come in and really establish a sizable position in a particular underlying. So that may or not be you. Of course, if that's not you, they do have alternatives for you these days, including a lot of the mini options and mini futures products over there at the CME. So I encourage you, if you're looking at a particular product, search for mini corn or search for mini whatever you're looking for and see if it is a mini listed on it. And chances are, if there isn't, there might be one coming soon. So that may be a way to help you dip your toes into the waters with a little bit less trepidation. And of course, the benefits of using futures, the underlying is a leveraged instrument. So that is something a lot of people are not used to. And so when you're coming to it, you can do a lot better than the 50% margin you can get on stock. So that may be attractive to you because you can come in and get leverage on the underlying, in which case you may or may not want to even use the options. It's up to you. Of course, when you have the underlying, it also has an expiration date. So that may also complicate matters for you. You may decide it's too much for me to have to deal with an underlying that expires and an option that expires, and making sure I have the right one for each, and I'm watching the right one and all that kind of fun stuff. But once you get used to it, those sorts of problems tend to mitigate, and you tend to get a little bit more used to them, particularly if you're trading only a handful of products. You get used to them pretty quick and how they work and how the futures work and what cycle they're on, and it gets pretty straightforward. It seems overwhelming at first, but it gets pretty straightforward pretty quick. And the other thing I would point out is that at the end of the day, of course, you also need to open up a futures account, so that's something you'll need to do. Again, a very streamlined process. Most brokers click on the futures tab somewhere in their online platform if they do offer them, and most brokers do these days. If they don't, I'd encourage you to seek out a broker that does. Just click that tab, say, hey, I want to open up a futures account. They'll say, okay, click on this button, agree to this, a couple of pages of stuff, and then bam, you're done. It might take a little while to approve it, might not. And then you're pretty much ready to go. It's all on the same interface. It's very streamlined, so it's not as much of a hurdle as it used to be. We had to have a futures account at one broker and your securities account at another broker, and never the twain shall meet. Usually they're pretty much two sides of the same coin now, which is much easier for a lot of futures options traders. And the last thing I would encourage you to keep an eye on is, just like we discussed earlier, the differences in skew in these products. That's going to be a little bit of something to get used to. If you're coming to it as a diehard equity options guy, used to investment skew, used to those puts having to bid, those calls essentially being deflated from a volatility perspective, you coming to the futures options realm, it's going to be a little bit of a different beast. So I encourage you, as always, do your homework when you investigate a new product. Look into the contract specs, of course, and also look and see how it performs in the real world. What kind of skew are you looking at? And there's a lot of good brokerage platforms that will show you that now. You can look at the skew in various products. There also are some good vendor platforms that can offer insight into the futures options realm. Indeed, futures options, the data is a little bit harder to find than the equity stuff. There's a legion of vendors who offer good insight into the equity options landscape. Fewer on the futures options side, but there still are a few. We work with a few on some of our futures options roundtable shows and others. I encourage you to check those out if you want to know more about who we use from a data perspective. But in a nutshell, those are the main things you need to be cognizant of when you're diving into futures options versus equity options. Just a quick overview, a quick primer, if you will. Maybe we'll dive into some more as we get some good listener mail on this topic and we can really sink our teeth into it. Dan, any last thoughts on futures options, sir?
Well, I just wanted to follow up on one of the things you were talking about, Mark, is that, you were talking about now it's easier because there's a lot of brokers out there who can service both futures options traders as well as securities options traders. And when that's the case, it's great, because I kind of forgot about that third problem that we encountered with our futures options class, is that there's still not really all that many dual brokerage firms, I guess, to coin a new word here, that service the futures and securities options people, because we were looking at platforms that were just for futures options. And I'll tell you, truth be told, most of them are so remedial. Like, all you can do is execute single leg options on there, and there's no analytics. Traders have to go and pay a couple $1,000s a month for analytics, like a separate software package outside of their brokerage firm to do their research, and then go execute it in a very remedial way. Like the options analysis tools that are pretty much standard and free with any securities options broker like LiveOwl or Thinkorswim or a lot of them out there. That stuff barely even exists in the futures world. And if you can find it, it's crazy expensive. So, that's just maybe one other hurdle that you might come across when if you do make the plunge into futures options.
But that's a good point, Dan. We do encounter still the functionality isn't always there. That's why it's nice to see some of the larger equity options players have finally started to dip their toes in the futures options waters, because they do bring that robust functionality that an equity option trader expects. They get the vol skew tools, they get the flow and analytics and the Greeks and all the other fun stuff that these great platforms have to offer. Because you're right, typically if you wanted to go futures options back in the day, you had to go to futures options broker, and they were, I think remedial is a good word for it in terms of what they offered from a platform perspective. They weren't engaged in that same arms race that the equity options guys were, so they weren't really keeping their platforms up to date. So it's nice to see some of the bigger equity options players you may already have accounts with, listeners, adding futures options now, because they bring some of those great tools and all that great R&D that they're already doing to the futures product, and it makes it much better of a trading experience as a result. So that's just our quick primer here on futures options. If you have more questions, send them in. We love to hear your questions on these topics. And speaking of listener questions, it's time to open up the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, welcome to the Mail Call, listeners. This is indeed the portion of the show where you guys get your chance to join us here on the old Bootcamp Drill Instructor Squad. No shortage of ways for you guys to do just that, including find us over there on the mothership, theoptionsinsider.com. Leave us a comment, leave us a website question through our feedback form. You can do it all right there. Of course, you can find us on social media, twitter.com/options, facebook.com/theoptionsinsider. Find us the old-fashioned way, questions at theoptionsinsider.com. Just be sure to put question for Options Bootcamp somewhere in there, either in the subject line or in the body, so we know how to route your question to the appropriate show. And, of course, last but not least, we've baked all of that into our mobile app, so you can find it all right there. Just hit that comment, that feedback tab, and you can shoot all that stuff straight to us, baked right in to the mobile app. Made it nice and easy for you. All right, first up here on the old mail call segment, got a question from Jim Horn. He writes, "Hey, boot campers. I keep hearing about a spread called," he writes it all in one word, "a 1x2. What the heck is that? Am I even saying it right? Great show. Thanks for educating poor slobs like me." Well, the 1x2. Mr. Passarelli, one of your favorite strategeries. What's your take here on our friend, Mr. 1x2?
Yes, the ever-popular Asian strategy from the Kung Fu movies is where I was first introduced to that one.
Yes.
1x2. Yeah, well, I think what we're talking about here is a 1x2, which is exactly as the name implied, one option by two options. So you would be buying one and selling two, or selling one and buying two. And, the funny thing about options is there's so many synonyms and different nomenclatures, depending on, if you hang out with the cool kids or somebody else, and a 1x2 can also be called a backspread. A backspread is a type of 1x2, or it's where I would sell one option and buy two options. Of course, with the backspread, I could also buy three options or four options, but if I do a one option by two, that's 1x2. Also, a ratio vertical spread, which is basically the opposite of a backspread. It's the same trade, but backspread's, selling one and buying two. A ratio vertical spread is buying one and selling two, which of course could still be 1 versus 3, 1 versus 4. But, that's really all it is. So probably, or at least possibly, you've already heard of this trade. It was just called something else, and maybe you've even traded it before, but it was called something else. So, yeah, that's it. No big mystique.
Yep, the old 1x2. I like that. I'm going to start calling it that from now on. I love our listeners. No slight intended, Mr. Jim Horn. It's just funny the way you wrote that one up. I like that. But yes, it is a very straightforward strategy. We've discussed it here on this program. We did a whole episode on ratio spreads, so look for that one if you haven't already, or just search Google for ratio spreads. You'll certainly find that, and you'll get into all the fun ways that you can break down that ratio. Like Dan said, 1/2 is just the beginning. You can go 1/3, 1/4, 3/2, all kinds of crazy stuff. People tend to get, I would just caution you, people tend to get a little crazy when they first discover ratios because they like to do them for credits. And so they'll say, if I can pretty much break even doing it 1/2 and pay nothing, if I do it 1/3 or 1/4, I'm collecting all this money and it's so great. And just remember, there's a lot of risk to that because, as you might imagine, if you're buying 1 and selling 4, the closer you get to that short strike, the more dangerous it becomes. And certainly if you blow through it, you can lose some money pretty quickly. And also, there's no free lunch. You may be collecting some money, but your broker is going to hold a lot in margin as a result of you having that naked short leg of 3 options essentially there. So there is an opportunity cost to that. It's going to tie up a lot more of your capital in that trade. So you're collecting more money, but you're tying up capital. So there's a definite opportunity cost a lot of people tend to forget about as well when they're doing these trades. But otherwise, very straightforward ratio, 1/2. A great question, Mr. Horn. All right, next up, we actually have a question that's kind of timely for what we're talking about here on the old program. This one comes from Tom Evans, writing out a beautiful, lovely St. Louis Mo. And he writes, what does more volume, futures or options? Also, does one do more electronically than the other? If I'm looking to dive into one, am I better off going into the futures or the options? Lastly, can you clarify the difference between SIBO and CME and CBOT? They all sound the same to me. All right, great question here, Mr. Evans. We'll take the last part first. There used to be a lot of exchange confusion out here in Chicago because there were indeed 3 exchanges. The ones you list, of course, CBOE, CBOT, and CME. That stands for the Chicago Board Options Exchange, where Dan and I both cut our teeth in the 90s there, or Dan maybe in 1972, and myself a little bit later. And then, of course, CME stands for Chicago Mercantile Exchange. CBOT stands for Chicago Board of Trade. Of course, the Merc bought the Board of Trade a few years back, so now they've all kind of fallen under the umbrella of CME now. It's all pretty much CME Group. CBOE is still an independent entity. We'll see how long that lasts. A lot of people speculating that the Merc will eventually gobble them up as well. So that's the 3 exchanges. CBOE, mostly equity and index options. Board of Trade did a lot of the soybeans and the treasury type options and futures. The Merc did pretty much everything else. They did the big S&P futures and options. They did Eurodollars, currencies, a lot of other stuff trading over there as well. So they all had kind of their individual distinctive product categories that they mostly traded. And now they all do a lot of the same stuff even as well. So there's products that are joint between SIBO and CME, like volatility products and things like that. All right. Mr. Passarelli, before I go on to the other part of his question, what's your take here for our friend Mr. Evans and his myriad questions?
Yeah, it's been an interesting and incestuous history for sure with those exchanges. I mean, it started out as the Chicago Board of Trade. That was the first exchange. And then they had the Chicago Butter and Egg Exchange, I believe it was, as like a little spin-off of theirs that eventually changed its name to Chicago Mercantile Exchange. And then the Board of Trade started the Chicago Board Options Exchange that got spun off and became the CBOE. And then the Merc that was once spun off from the Board of Trade ended up buying the Board of Trade. And, you know, like Mark said, who knows, might end up buying the SIBO itself. So it's a pretty interesting history for sure.
I think incestuous is a good word for it, sir. And as to your first part of your question, I did some research after I saw your question come in here. And luckily, our friends over there at FIA, Futures Industry Association magazine, just came out with their big global futures and options volume survey. They surveyed about 75 different exchanges around the world. So they have the actual answer to this in terms of what does more volume globally and indeed domestically. Options or futures. It gets to be a little bit hairy when you're comparing a contract to a contract because, of course, a product with a big multiplier is a different beast than a very small product. So a contract is not created equal at the end of the day. This is just looking at contract volume. But from an overall contract volume perspective, this is from So the first 6 months of this year, Jan to June of 2014, futures worldwide did about 5.6 billion contracts. That was down about 15% from last year. And options did about 4.4 billion contracts, down about 10% from last year, for a total combined of a little over 10 billion contracts so far globally, at least for the first 6 months of this year. So you can see futures doing a hair more, but that gets into some weird products like the Kospi and others that have very, very small notional values. And so it's kind of hard to say on a pure notional value which is doing more. I might actually lean towards the options in that sense, because there's a lot of big options out there that represent a lot more notional value than some of these small esoteric international futures that are going up almost like candy from a total overall volume perspective. And the last part of your question, if I'm looking to dive into one and I'm better off going with the futures or the options, well, I think you know where we stand on this show. We are dyed-in-the-wool options guys here, so we tend to prefer the options, but it really depends what your use case is. If you want a very, very quick exposure to some underlying and you're okay and comfortable with all the caveats we laid out earlier in the program about using futures, and you want to embrace that margin multiplier they give you on the underlying, then the future is certainly a great tool as long as you're comfortable with an underlying that has an expiration date. Otherwise, all the things we talked about here on this program that apply to options apply to futures options, like we said, so they have a lot of great advantages. I certainly lean toward the options. Mr. P, what do you have to say here for our friend Mr. Evans on the other two portions of his very, very lengthy but interesting question?
Yeah, I mean, it is like Mark said. I mean, different animals, apples and oranges here, if you will. I mean, one way to look at it, probably the best way to look at it, is notional value. The securities options market, the notional value is about 25% of that of the U.S. stock market. So one way to read that is 25% of the U.S. stock market is controlled or hedged by options. You know, and that's one way to put things into perspective, not necessarily relating it to futures, of course, because you can't really relate futures in that same regard, not to the notional value of the U.S. stock market. It's two very different things, and they have two very different uses. But, you know, there's a whole lot of liquidity when it comes to equity options these days. And, you know, notwithstanding the conversation we had before about just the sheer number of choices you have in the equity options market.
Yeah, I'm just breaking down this list while we're looking here, and some of the top contracts, like the top equity index future and option for this past year was the Nifty options on the NYSE in India. It has a notional value of essentially 50 Indian rupees. So that's why it's doing about half a million contracts so far this year. I mean, because it's a tiny contract compared to Eurodollars, which has 1,000. It's essentially a contract with $1 million, dollars, or like something like the Brent crude, which is 1,000 barrels of crude. These are large contracts versus something like that. It's apples and oranges when you start comparing these things. By the way, just for a little bit of further breakdown for those of you who like that, are interested in these kinds of numbers, then overall I mentioned of that 10 billion futures and options that traded the first 6 months of this year, about a third, a little over a third of that, a little over 3.2 or so billion contracts came in individual equity options and futures. So mostly options in that sense, not a lot of equity futures kicking around unless you go to Europe. And then the equity index futures and options made up about 2.5 billion of that. So you're talking about 5.6, 5.7 or so of that 10 billion pretty much lumped into the equity and index option stuff. Then it starts falling off from there. 1.6 billion interest rates, currencies, just a hair shy of $1 billion, and they just drop off from there. Agriculture, energies, et cetera, et cetera. The more esoteric of the product category, of course, the smaller the volume. So individual equities and, of course, equity indexes making up the lion's share of that global volume. We got time for one more here in the old mail call. This one comes from, I don't have the listener name, I think it goes by, must be anonymous, I suppose, and he or she writes, on several of your programs you mentioned that it's important to understand the VIX cash level at a given SPX level. Can you please explain this further? As an example, what are the implications of a 12 VIX at 1800 versus a 9 VIX at 1800? Likewise, as a 15 VIX, how does a 15 VIX at 1800 compare? This question probably came back a little ways because he's talking about 1800 level, and the SPX were, of course, hovering around 2000 these days. But the levels are immaterial to what he's actually talking about here. When he's talking about, this is what we talk about as the context of volatility, something that drives me crazy when I see it just bandied about. The VIX is at 15 on the CNBC. They give you no context for that number. A VIX of 15 with the S&P at 2000 is a much different beast based than the VIX of 15 with the S&P at, let's say, 1,500. One represents way more volatility than the other because remember we talked about volatility skew. In general, as you rally up in these indexes, volatility should decrease. So you expect a generally lower level of volatility, aka lower VIX, as you rally in the S&P, and same thing to the downside. As the S&P drops, you expect that level of implied volatility to increase. So you expect a higher level of a VIX at a lower S&P level, like a 1,500. So if you have that same VIX level at a much higher level in the index, that represents a surprising scenario. Something is at work there to cause that to be inflated, because it shouldn't be. From everything else holding steady as you progress up that volatility curve, that skew, that volatility level should come off. So that means something is afoot there. Something is causing that level to be inflated, and you may want to pay attention to that when you're trading, because that represents a much higher level of volatility than the other level that you just talked about. All right, great question there, Mr. or Mrs. Anonymous. And if you want to join them, have your questions or comments read here on the old program, you know how to do it. Find us at theoptionsinsider.com. Find us on social media, or check out our mobile app. It's all baked in there as well. And before we go, though, as always, I'm going to check in with my partner in crime here on the old Bootcamp panel, the Bootcamp Drill Instructor Squad. Indeed, my lifetime nemesis, Mr. Dan Passarelli, and see what's cooking in the land of the market taker. Mr. P, what's cooking in the land of MTM, sir?
Man, we've been doing a lot of traveling. I mean, historically, a lot of our classes are online, that's mostly convenient for everybody. But we've got a lot of requests lately from people to have us come out to their location. Maybe they've got a little group of people and, they want us to address their group, or maybe they've got a really large group. I was just in Kansas City last week for a, small group, about 6 people or so, and going out to Portland this weekend to do a group of about 20 people. And then in December, I'll be in Denver talking to a group of, I think it's probably about 40 people, if I'm not mistaken. So if there's any listeners who have groups, large or small, and would like to set up your own private little in-person class, we'd be happy to entertain the idea of talking to you about maybe having us come out and visit you. We've been doing a lot of that lately, and frankly, we kind of enjoy it. So you guys know how to find me, I think. Dan at markettaker.com. Market like stock market. Taker like you take something off the table, 2 T's in a row. Dan at markettaker.com. And we'd be happy to talk with you anyway about maybe setting up a little in-person event.
There you go, listeners. Take Dan up on his offer. I encourage you to do that, because he'll come right out to your house. He'll do it in your living room. He'll bring his bass guitar. He'll play you some songs after. It's a nice show, I find, for 1 or 2 people. So if you want him to fly across country to teach your mother about options, he's the man to do it.
Thank you, sir.
Of course, take him up on that offer, listeners. It's a great one. Dan at markettaker.com to learn more. To surf on over to markettaker.com. And on behalf of my nemesis and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, keeping Bootcamp rolling along, sending in such great questions. Keep them coming. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.